And you have an example trade, this one being bullish. Care to share? Let's check it out.
Yeah, Nicole, a couple different ways to look at this one. The first one I'm going to take a look at is mostly bullish, right? Taking advantage of maybe if you think the stock's going to move higher post earnings. It's down a little bit today on the news that China might be ramping up their AI chip production over there. I think that's denting the stock here a little bit, but the stock's up 34% so far this year. If you expect it to have a good report, a lot of the whisper numbers as far as revenue are 1, 2, 3 billion above what they expect at this point. So that could be, a bullish sentiment here. So I looked at a strategy that's not a pure earnings play, though. I'm not doing anything in the August 29th weekly cycle that expires on Friday. I went out to the September 19th monthly options that expire in 23 days. For a call vertical, buying the basically at the money 180 strike call, and then against it, we're going to sell the 195 strike call. So a bullish $15 wide call vertical to the upside. You're going to pay roughly, I've got a $6 debit on here. You can see there from the risk profile, it's probably trading closer to $5.50 right now because the stock has continued to move down. But the debit you pay is going to be your risk. So if you pay $6, you got $600 in risk. That can expand to $15 if it goes above 195, which would be a fresh all-time high on the stock. It takes your break even up to 186 to the upside. That's only about just under 3% above the current share price. And the option market pricing in about a plus or minus $11 move in the stock post earnings expected on a one-day move. That's about 6% either way in the shares. So this is well within that one standard deviation move. Pretty directional, and because you're buying a vertical like this, paying a debit, if you get the move you want, it gives you some flexibility as far as trade management goes. You can close it ahead of expiration over the next 3.5 weeks, or you can wait, let it try to get max profitability if it goes above 195. The only thing you don't want on this one, Nicole, you don't want this thing to stay where it is or go lower.
Yeah, understood. Okay. How about a more neutral example trade? I mean, there are some concerns that maybe this is fully priced. I heard at least one person say that this morning.
Yeah, they've been wrong over the last couple of years if they said that, Nicole. Right. But this one's a little bit more conservative. You're playing probabilities on this example trade. It's still taking that bullish directional bias, but I shortened up the duration. I went out to the September 5th weekly options, so about 9 days to expiration on this one. Not a pure earnings play. In case you do get a pullback in the stock, it gives yourself some time and an additional week for the stock to kind of rebound. But going out to that September 5th weekly options, selling the 172.5 strike put, and then against it, because we always want to stay risk-defying going into earnings on this, buy the 167.5 strike put. So a short, neutral to bullish $5 wide put vertical. You're going to collect roughly, I've got a $1.25 credit on here. Probably collect closer to $1.50 on it right now. But if you do collect that $1.25 credit, that's what you can make, $125 in profitability on this one with $375 in risk. But the key here is the break even on this one where you start to lose money goes all the way down to 171.25 to the downside. That's just over 5% below the current share price. So almost that one standard deviation move on this one. The probability that short 172.5 strike put that you sell in this strategy will be out of the money at expiration, about 67%. So there's the trade-offs that we talk about. You've got more risk on this one than what you can profit on it, but at the same time, you're giving yourself a better probability of success where you've got over a 5% cushion to the downside before you start getting hurt on this one.
Exciting backdrop today for sure for the market, for the AI chips euphoria that's been going on, and if it can still sustain despite significant headwinds with China export restrictions. We'll have to see what Nvidia comes out with, but I am feeling pretty optimistic at this point.
So at this point now, I mean, a lot of folks talk about how Nvidia is known for beating the street. We've seen a lot of price target raises, too, on names like Nvidia and AMD. Though there is some concern about the price of the stock. Is it too frothy, for example? Do you expect the beat? Do you, obviously go along with the price target raises that we've been seeing in some of these tech names?
I do, and I'll tell you why. I think if we think back to what Nvidia guided on last quarter, for the current quarter, they offered a raise, and it was despite a significant hit in China export restrictions, $8 billion hit. They quantified it for us. And I expect that they're going to make that number and they're going to guide up for the coming quarter. And really, there's also some tailwinds coming in because those restrictions are being lifted a little bit with potentially deals with the U.S. government, a little rev share deal for Nvidia and AMD to ease those restrictions. So the other thing we need to remember too is that demand still far outstrips supply, and I think Nvidia is shipping any Blackwell chip that isn't nailed down to all other geographies in addition to China.
And so at this point, look, we hear that NVIDIA will also have a new brain, and that could also sort of boost the bottom line. Do you think there's something to that?
Absolutely. I'll be listening closely to this earnings call on the company's messaging for its annual AI chip architecture release cadence that it has committed to. And I'll be listening closely to what's coming beyond Blackwell, the company's Rubin chip architecture. They should be talking a little bit about that, so I'm going to have my ear to the ground on that. Another area that's a big growth opportunity for the company is physical AI, otherwise known as robotics, right? So physical AI, industrial robotics, autonomous vehicles are a type of robot, for example, and even, yes, those humanoid robots that might be a little freaky in our homes. They're working on this. This is a significant tens to hundreds of billions of dollar market opportunity. The company just got through releasing this week its Jetson AGX Thor developer kit for developers, a tool based on Blackwell. This Blackwell architecture in robotics also brings a significant performance uplift. And so the company's betting big on robotics to add additional opportunity beyond just the data center. The other area that I'm going to be listening to is GeForce Gaming. We're running up to the holiday shopping season now, and GeForce is a significant performance leader in the PC gaming market versus rivals like AMD. Recent price softening closer to NVIDIA's MSRP has come to fruition in the market, and I think it's going to make gamers a little bit more apt to make a move on a new graphics card in the shopping season. So I'm going to be interested to hear what they report on GeForce and for the future quarter as well.
Yeah, I like all those details there. I mean, when we talk about the Blackwell chip and getting that now, negotiating to try and get that over to China, we did see the 15% of the revenues of chips sold to China will go back to the government. Are you okay with that? I mean, in fact, I think they did a negotiating process, 20%, 15%. What do you think of something like that?
Yeah, it's interesting. I'm not big on having government meddling in my tech. I'm a tech analyst, and it kind of goes against the grain. But we have to remember, NVIDIA is shipping its H20 chip, which is actually based on previous generation chip architecture. It's not Blackwell. And it's kind of a gimped chip, if you will, that is, targeted specifically for the China market to give them NVIDIA's tools to develop on and silicon to build upon. But it's a couple of generations back. And so I'm okay with it. I hope the rev share deal works out for NVIDIA and AMD and allows them to ship, more readily into China because I think it's important for the developer ecosystem over there to have access to the product in developing on U.S. technology.
What do you look out for?
Revenue, always. I think we're expecting really solid numbers. Couple different dynamics under the hood, but I think this remains a supply-constrained growth story. So it's pretty amazing. If you look back at NVIDIA's numbers over the last several quarters, they've added the same exact amount of revenue each quarter. What that tells me is their revenue is basically a function of how fast the supply chain can crank out product. So I think the demand environment remains very strong. That's not the issue. The question is, how fast is the supply chain able to accommodate product?
And under the surface, then, not too bothered about the bottom line and any costs that are rising?
Well, of course, I think if we step back, Nvidia, where the stock is just below an all-time high, I think this earnings setup is a little bit different from the last couple of quarters. Expectations are very high. There's a lot of optimism around the stock. So I do think it's not revenue and nothing else. I think revenue is the most important KPI, and then we're going to need to see solid gross margins and earnings as well.
What about guidance and I guess the conversation on the earnings call in and around China?
There's a bit of, so there's a bit of, a question mark about what they will be assuming for China in the forward-looking outlook, because there's been a lot of moving parts.
How much of the business is it for you?
In the forward outlook?
Yeah.
I think they're not going to include China in the forward outlook. That's what other semiconductor peers like AMD have done. I think that is the conservative approach. I think that's the fair thing to do, given there are still uncertainties around when they're going to get some of these export licenses for the new China-compliant products.
The other thing I wanted to ask about, a broader thing, which I've seen people write about in the last 6 months, is accounts receivables increasing.
Right.
What's your take on that? Is that a risk that some of their customers are a bit behind the curve, or is it in fact misleading?
I think that situation has gotten better as time has gone on. I think we're going to see that continue to have improved in the quarter that they most recently reported. If you look at their supply chain, what those partners have been talking about in the latest earnings cycle, it seems like they've just gotten their hands around how to accommodate NVIDIA's very complex set of products. And a lot of those supply chain partners have significantly increased their expectations for output of NVIDIA's product through the balance of the year. So I think supply chain bottlenecks have gotten better, and I think you'll see those dynamics improve in this quarter.
Different question as it relates to China, which I've heard from various sources that the attempt to kind of contain China by the US hasn't worked. Their innovation has been very, very strong behind NVIDIA's, but it's catching up. What risk do you put, whether it's from China or elsewhere, that a player catches up with the scale of quality that NVIDIA has, and that pricing becomes a big issue in the next 6 months or 5 years?
Yeah, I mean, I think you could probably ask a similar question about Western competitors, too. Is anyone going to catch up to NVIDIA? I think NVIDIA's got a big lead, a big head start on all competition, particularly China. I think the most formidable Chinese semiconductor design competitors are still years behind NVIDIA. But to the earlier part of your question, if the U.S. decides to clamp down and restrict China, which it doesn't seem like they're doing anymore, there are workarounds. And I think we've seen a company like Huawei develop pretty good products that aren't quite as cost performant as NVIDIA's, but in an environment where Chinese companies are restricted from getting NVIDIA, Huawei can be a decent alternative. So that's why I think the U.S. administration is smart to allow NVIDIA to participate in China. I think we're better off if Chinese AI is built on a U.S. company's technology.
But you feel
rest of the world,
you feel
too.
like, I mean, that is a strategic, philosophical view. That is not a view that relates at all to U.S. taxpayers getting a VIG on those chips being sold.
Yeah, so you're talking about the revenue share that the administration has.
That's the nicer way to put it. Yeah.
Yeah.
Revenue share.
I think that's a different conversation. I think strategically, yes, it is smart for the U.S. to allow NVIDIA to play in China.
And that is good for America.
I think it is.
Okay. No, the reason I mention this is we go back and forth with Howard Lutnick. We spoke to the Treasury Secretary about this issue, which is, there are times when the U.S. can do things economically that are good for the country that don't also need to capture somehow. We're not giving stuff away for, there's actually like a benefit to the country, even from a national security perspective in your mind.
That's what I think, yes.
But I just add to that from the European perspective on that. This is different. So I remember 2018, 2019, I remember talking to Mike Pence about it, that the US then wanted the UK not to use Huawei in our 5G rollout. Mm-hmm. And the UK government bent and it was actually a lot of cost to remove because it was already halfway down the path. The difference, I think, the US is also working with this time, why maybe opening up and working with China is better than containing it. If you look at the last 6 months, and the way that trade policy has been announced, right or wrong, Europeans, including the Brits who are close to the US more than most, will look at it and say, well, why don't we just buy the Huawei chip? It's a lot cheaper. There's not the same resolute mindset to contain and block. And so you're contending with that as well in a way that perhaps you'd get more adherence the first time around.
I think in that market, there are viable alternatives to Huawei. In this market, there are not great alternatives to NVIDIA.
But we got to start talking about NVIDIA. Sure. What are your thoughts about NVIDIA and the implications for the market? We were talking about it earlier. It's about 8% of the SPY, which is the S&P 500, about 10% of the NASDAQ 100, and almost over 22% of the SMH, three very popular investments. What do you see happening today after the bell?
Yeah, NVIDIA certainly moved the market in the past on its earnings. We think they're going to beat on the top and bottom line, but I think the market will be looking for their guidance going forward. Are they going to say anything about China in their guidance? And then also, what are they going to say about data center growth? And that's a bit of a proxy for CapEx overall. There's pretty high expectations for CapEx growth across the big cap tech companies in 2025.
So I'm sure you've noticed, seen a lot of broadening in the market. Yep. A lot of the unloved sectors seeing some big gains. Healthcare has been one in recent weeks. Is NVIDIA an inflection point for the tech trade in your mind? If NVIDIA does well, does that mean investors pour back into the AI trade, mega cap tech, or does the broadening continue?
I think the broadening could continue. Lower rates would certainly benefit some of the beaten down sectors. Small caps, for example, I think would benefit from lower rates. But there's also a lot of liquidity out there. There's about $7 trillion sitting in U.S. money market funds. That's up from $4 trillion just a few years ago. That money would easily find its way into big cap tech if NVIDIA beats.
All right. What about froth in the market and also just investor sentiment, maybe nervousness, whatever word you want to call it? Looking at B of A, they just put out a note on their flow show. They call it flow show, looking at their clients. Clients sold stocks in 9 out of 11 sectors, led by tech, staples, and financials, and hedge funds were also the biggest sellers of equities. That was last week going into Jackson Hole. Do you still think the market has that same, skittishness and concerns about froth?
Well, Jackson Hole's been an inflection point in the past, so I think there probably was some risk. We've seen a lot of volatility earlier in the year. Volatility's really tamped down quite a bit in the last couple of months, but I think there's a risk. With risks at both sides of the Fed's dual mandate, I think we could see weaker employment numbers going forward, but also maybe a uptick in inflation, and maybe the Fed disappoints on that second or third rate cut. So I think it is a volatile time in the market.